In today's episode, I'm going to teach you how to find your edge in the stock market. At the end of the day, being able to produce profit consistently requires you to have a niche, a strategy, a system, a set of rules of how you find things to trade, where you get in, where you get out. And you've got to have a track record that proves that when you follow that system, you have predictable results. Now, we have to recognize that as retail traders, we have the cards stacked against us. We're not Wall Street institutional executives who are able to just seemingly print money. We have to work doubly hard for it. Now, I've got a great slide deck for you, and what we're actually going to be talking about is a $700,000 investment in Intel. I don't know how many of you guys have heard about this, but there's a post on Reddit about a college student who received an $800,000 inheritance from his grandmother. And what he decides to do with it is invest $700,000 of that inheritance right into Intel stock. And I think this is a great case study about knowing your place in the market and knowing whether or not you actually have an edge. Because as it turns out, retail traders trying to pick individual stocks and YOLO our full account on it, we don't have an edge doing that. But there are pockets of safety in the market where retail traders seem to do better. And I want to help you find your way to that niche. I want to help you develop your edge so you can start to develop a sense of confidence in the system and strategy that you're following. I'm going to share mine with you today. All right, so let's go ahead and jump into our slide deck. This is going to be a great class. I hope you guys really enjoy it. And for those of you tuning in, perhaps for the first time, who have never watched an episode here, I'll introduce myself briefly. My name's Ross Cameron. I'm a full-time day trader. I've been doing this for more than a decade. And in fact, as we talk about in today's episode, I took my first trades with real money in 2001, which was 23 years ago. And I started getting interested in the market in the late 1990s during the dot-com bubble. So I'm going to share with you some of the biggest mistakes that I made early on because I went through this period of trial and error before I finally found my edge. And of course, I share my edge with all retail traders who are interested in learning because it's not exclusive. This is a strategy that I trade today that's been traded for decades and decades. It's a consistent strategy once you learn to have the discipline to follow the rules of the strategy. Okay, but let's first talk about the topics of today's class. We're going to talk about the Intel gamble, which is our case study. Then we're going to talk about finding your edge, and I'm going to share with you my biggest mistake. And I'm actually going to share a couple of those mistakes. So let's start with the Intel gamble. Okay, so there was this post about a month ago on Reddit. And this individual post, he says, I bought $700,000 worth of Intel stock today. Now, some of you may have heard of this because it definitely gained some traction. So the TLDR is, Grandma died 2 months ago. All right, so that's unfortunate. Left me an $800,000 inheritance. I'm a junior in college as a math major, and I don't really have any use for the money, nor do I have any debt. Well, that's great. I always heard about people losing their inheritance by spending it on garbage instead of investing. So I told my parents, I'm not going to spend a cent of this money. I'm going to invest it all, and they were proud of me. All right. I put $100,000 into a high yield savings account, and I bought $700,000 worth of Intel stock at the market open. I plan on holding this position for a decade, depending on how it performs. So now he states the reason he likes Intel. And I call this the Intel gamble. So I want you to think about, why would I call this a gamble? Number one, it's naive to think that we, as retail, have an edge stock picking. Now, if you've read any books by, let's see, I've got a book here by Benjamin Graham. This is a popular book on investing. And if you've listened to Warren Buffett, one of the things that he says is diversification. He has a quote. I don't remember the exact quote, but he says, if you really know what you're doing, you don't diversify. You put your money into what you believe in. And so historically, Berkshire Hathaway has not been a terribly diversified fund with hundreds and hundreds of different investments. They've consolidated across a few huge investments, Apple, Coca-Cola, Geico, these other companies that they really believe in. And that has clearly worked very well. The common held belief is that to manage your risk, you have to diversify. Don't put, so to speak, all your eggs in one basket. And so I think that sometimes retail traders will naively think, all right, I'm going to follow along with that. I'm going all in on whatever it is. But there's some inherent risks with putting all your eggs in one basket, right? So I'm going to talk a little bit more about that in a second, but I think it goes without saying that when you put everything into one stock, if that one stock crashes, your account's down 50% or whatever it is. I mean, you could lose your whole account potentially in one trade. Whereas if you were holding a ETF like the S&P 500, you're diversified across 500 stocks. So if one of those stocks goes to zero, that's only one of 500. Right? So in terms of percentage, it's like you don't even lose 1 percentage point with that one going to zero because you're so well diversified. And however, the downside with that diversification is that when you have one stock that really performs super well, it kind of it lifts up everything a little bit, but not enough. So ultimately, you're kind of banking on just the overall trend. But historically, when we look at market returns, that has been the more conservative way to invest, and it's also been historically profitable over long-term periods of time. Putting your money in index funds works. That's what we've been told. That's what we know. So I think it's naive for us as retail traders to put all our money into one stock and think that we know better than the market. Number two, this position on Intel is a contrarian position versus the current market performance. And so what I'm actually going to do is I'm going to jump out of my slide deck here just for 1 second. I'm going to pull up. So this is the Reddit thread here, and this is the screenshot of Intel when he bought it. He buys it, and you could see, of course, Intel has been dropping. His position is worth $692,000. It's already down almost $8,000 on the day. And his average position cost is $30.45 a share. But if we pull up the charts here, and I'll just move this out of the way for 1 second, and we look at Intel, what you'll see, and we'll just go to like kind of right here, because this is where he bought. I would say this is a contrarian investment position because the stock has been this year trending down. So buying when the stock is trending down, in other words, you're buying and you think you know better than the market, because there's the saying that the market has priced everything to perfection. Everything that's known about this company right now is known and is therefore factored into the price. So investors collectively, and of course retail traders, which make up only probably 20% of the volume in the market, but primarily institutional traders, have priced Intel at $30 a share at that exact moment. And if we look at that chart, I would ask, is this a momentum trade? Now, for those of you who don't know me well, I am a momentum trader, which means I've built my strategy on essentially buying things that are already trending up. I never buy something that's not already moving. I need to see that something is moving, and then I buy high, essentially, and sell higher. So if I bought something like this up here, some people would say that's high, but then when you sell it up here, you're selling higher. So I buy high and sell higher, but of course I do that with a tight max loss, a tight risk parameter on all of my trades. But I have found that it is so much easier to trade with the trend versus to try to predict when it's going to reverse. Because when you're trying to predict when it's going to reverse, you're trading against the market. You're essentially saying, I know better than how the market is currently performing and how the market is currently pricing this stock. So my second reason that I think that this is a gamble is because he's taking a contrarian position versus market performance. And so then you could say, well, what is his thesis that gives him that confidence? And so if we look at his thesis here, he says 2024 Q1 up 9% year over year. So, okay. Intel has been heavily invested in restructuring by building out domestic foundry business to manufacture semiconductors. Okay. NVIDIA, AMD, blah, blah, blah. So he's got sort of, these 10 bullet points. Trading at a PE ratio of 17. I like the stock and I think it's really cheap. He also notes that he's a math major, but he's also a junior in college. So not to dismiss, a lot of people do great things when they're young, but what I would argue here is that this has no mention of risk parameters. I didn't see any mention in here of, max loss. Like I'm gonna take a loss on this if it drops 10%, which would be an exit at $27 a share or something like that. And number 4, it is reckless to put 90% of your funds into one stock. The only thing that would make that not reckless is if you had a proven track record of success at picking stocks. But I'm going to guess that this person does not have that track record based on their age, based on what's been stated and shared, and based on the fact that they just received this large inheritance. So when we look at Intel, what ends up happening is 7 hours after he takes his position, horrible timing, Intel announced that they're suspending their dividend, which is literally like one of the worst things a company can do, because when you get rid of your dividend, I mean, it sends a huge signal to the market. And they're cutting 19,650 employees. The stock collapses down over 10%. Within a day, the stock is down 30%, and it's at the lowest level in 8 years. Holy smokes. I mean, I remember once seeing a thread about someone who bought Amazon stock, and 30 minutes later, Jeff Bezos resigned as CEO. And he's like, I can't even imagine how I could have timed this worse. But you know what? Here's the thing with Jeff Bezos resigning as CEO. How many people do you want to wager kind of already knew that was coming? People on the inside, people who were, had their ear to the ground and they're connected. Now, there's a very fine line between insider trading, which happens on Wall Street, as we know, and this just sort of collective, like you're in the circle of, the social circle of all these big parties in New York or LA or wherever, and you just kind of know things. And I feel like this is the thing where it's about the connections, and these Wall Street executives, they just have the relationships where they're going and playing golf with the CEO of some of these companies. They just know stuff. And to the extent that they take action on it, I don't know, but we know a lot of them do. And it's just the way it is. So as retail traders, we don't have that edge, right? We simply don't have that edge. We never will. And we're left to essentially work with, it's sad, but we have to do it the old-fashioned way. And as it turns out, the old-fashioned way is quite difficult. So in the case of Intel, now the stock has dropped 30%. He's still in at $30. It's at $18 now. It's hitting basically the lowest level in 8 years. And now it's they're talking about it getting delisted from the Dow Jones Industrial Average. And if it's taken off that ETF, then that's going to mean even fewer people are buying it. And it's just not good for the stock at all. So, you step back and you look at this and it's like, okay, this is a stock that historically has, been volatile, but it's been left behind. You look at other companies like, Microsoft, MSFT, you look, of course, at NVIDIA, and these are companies that have been much, much more successful with AI, with chips and everything else. And Intel has been left behind. So to take an investment on Intel, and especially to take what is essentially a YOLO investment, you only live once type of trade, I would say that is gambling. Now, Redditors tend to agree. This is someone posting, your Nana in heaven watching you lose your entire inheritance on the Intel stock. That's a tough post. And he's down 100K in 30 seconds, right? You should probably drop your math major because you aren't learning. Look, I mean, Redditors are going to have their opinion. This is bad financial advice. I'm paraphrasing that. Did they have a math class called "Putting All Your Eggs in One Basket 101"? I'll give that. I'd give that the thumbs up. So, all right, fair enough. He got wrecked, and it's a learning experience. So what I'm going to do now is I want to share with you how to find your edge in the stock market. Clearly, just throwing your money on one stock is not the ticket. That's not the way to do it. But there is a path to success in the market. And of course, many people have taken that path and have found great success. So I think your job as an aspiring trader, or even as someone who's been doing this for a while, is to learn the path that people have taken that's led to success and to try to follow it as closely as you can. And to be very cognizant of the path that people have taken that lead to failure and to avoid that path at all costs. It's very easy to be overconfident in the stock market and to be put in your place quickly. So I think the first thing for a beginner trader is to acknowledge the account size that you have. So what account size are you working with? Now, you guys are all in different places. And I've been in all of these places at various times. I've traded with a $5 million account when we were trading the GameStop short squeeze. I've traded with a $500 account when I had $583 in my account in January of 2017. And I've done $5,000 accounts, $50,000, $500, everything in between. So I've done all of this. But what I can tell you is that your account size is important for the strategy that you're determining. Now that you're planning to trade. Now, this individual on Reddit, he's coming in with a $800,000 account. So that is a naturally very large 6-figure account, nearly 7-figure account. That's probably not going to be most people who are approaching the market. So if your first question is your account size, I think the second has to be your risk tolerance. With a $500 account, I think you have to be willing to risk it all. And look, I understand that some people are like, I'm going to take my $500 account and I'm only going to risk 10% of it. Okay, all right. If you want to take $50 of risk, that's fine. But I think you have to accept that there's a good chance when you're trading with $500, especially if you're actively trading, that you could lose it all. And here's kind of the problem. We could do a compound interest calculator if we wanted to, but if you're starting with $500 and you're only willing to risk 10%, you're risking $50 on that account. So, if it goes up $50, you make 10%, you're at $550. Goes up another 50%, 10%, you're at $605. You can grow the account, but it's going to be slower if you're not taking more risk. And if you were doing 10% and you were investing in the S&P 500, this would be year 1, year 2, year 3, year 4. So it's going to take you 5 years to get to $1,000, realistically. So that's not going to be a good use of your time, and that's not really the best way to grow a small account. When you've got a small account, you're thinking about how I can grow it quickly. When you've got a $500,000 account or a $5 million account, you're thinking about how I can preserve that account, make sure I don't destroy it, and how I can get, incremental growth, but without taking obscene levels of risk. So this is kind of the way I think about it. And this is this isn't risk per trade. This is like risk per year. So with a $500 account, I'm willing to lose the whole thing in a year, and that I could tolerate that. With a $5,000 account, maybe I'd be willing to lose half of it. All right, I'm gonna take some risk. If I lost half of it, I could tolerate it. A $50,000 account, now maybe there I only want to lose 20%. That'd be 10 grand, right? You don't want to lose too much of that. A $500,000 account, 15%. Now, if you put it in the S&P 500, you could have a year that it goes down 15%, but you could have a year where it goes up 15%. So, maybe you're okay there. And then with a $5 million account, you might feel like I can't put it all in the S&P 500 because that is too volatile. I don't want to lose a full 15 or even 20%. So now you're starting to think about stocks and bonds to reduce your downside risk. At the end of the day, you have to think about risk first, because you are the one who is going to be sitting with your account when it is at its worst. When we have a terrible stock market crash, we have a terrible recession, you're the one that has to look at your account and be accountable and take responsibility for the value that it's at. And if you can't handle looking at an account that's down 70%, well, hopefully, that would be pretty bad, but 30% or 40%, then you can't invest in the type of stocks that could result in that happening. So YOLOing your entire $700,000 account on Intel and having Intel drop 30% because they put out bad news, which most likely Wall Street executives already knew was coming, right? And they already moved out of the way beforehand. That just adds salt to the open wound, but that's the reality. So then that's not the risk tolerance or the type of strategy you should be trading. Now, the next question is about your time commitment. Now, number one, do you have the time to actively trade the market? Because in a sense, what I do as a trader, I trade every single day, and I'm trading my time for the money that I make trading. So it takes time. It takes time to learn how to trade, actively day trade, and it takes time to trade the market every single day. Day trading is not passive income. You have to actively trade. You possess a skill. It's not like just owning a bond where you just collect money each year or whatever it is, whatever the basis is. You just collect the money and you don't have to think about it. It's not like that. So if you have the time to actively trade the market, then then that's something that you could certainly consider. When we think about, sort of the trade-off of, all right, if I'm going to spend my time, let's say, going to college, then that's going to give me the earning potential in the next 5-10 years that I can be earning six figures. I can get a nice job, da, da, da. So it makes sense right now for me to spend my time focusing on going to school, not trying to day trade. Okay, that's fine. But if you're at a place where you're like, all right, I've done school, I've got a job, I don't love it, I'm going to start spending an hour a day focusing on learning how to day trade and actively trade the markets. It's going to be in addition, and maybe I'll get to a point where I can transition, then okay, that's the consideration that you're making. Either way, if you have the time to actively trade the markets, it's a opportunity cost that you have to make of, is my time spent studying and learning the market, does it have the potential to earn me more than my time doing something else? And then am I motivated enough to prioritize not watching, or playing video games at night and instead learning how to trade? Just as a side note, I used to play video games a lot. And once I got into trading, I stopped playing video games. It wasn't a conscientious decision. It was just that it was just the reality that I was like so focused on learning how to trade, it almost became like a video game. It was like, I wanted to beat the next level. I wanted to achieve this next goal. And so I got so consumed with like learning the technical indicators and learning how to use my hotkeys and learning the entries and the exits that was my focus. And it's a lot more rewarding than playing a video game, because if you win, you make money, right? So anyways, it just kind of naturally happened. And it's just like, next thing I knew, my PlayStation had dust on it and I hadn't played it in months. And then it was years, and now I don't even have one anymore. So anyways, but that's a decision you have to make. Now, number two, you could say, I can't actively trade because of, that's the decision I've made. I can't actively trade, doesn't fit within my schedule right now, but I can actively monitor investments. And I am interested in reading about stocks and being more active. And in this position here, this is where, to be honest, things can get a little dangerous, because this is where you can get overconfident and say, oh, I've been watching NVIDIA for a while, or I've been watching Intel for a while. I'm going to go ahead and, buy this stock and maybe mismanage my risk and put 95% of my portfolio in it. So you've got to be really careful here that you're thinking still about risk first. But if you're able to actively monitor investments, my kind of mental thought process on this is that most people are going to start here at sort of level 3. They're going to eventually get into level 2 because they're going to get more engaged, and eventually they'll make their way to level 1. So, and that's how it was for me when I first started. Well, it's not exactly the case, but when I got some money from my father, I had gotten inheritance from my father when he passed away when I was in my 20s, and I took that money and I just invested into the market with a financial advisor, and I didn't have to do anything. And I had the benefit of just receiving passive income. However, that was when the market was crashing in 2008, 2009. And so what ended up happening was I just got statements each month of the account going down and down and down. And I was like, this is ridiculous. That's what motivated me to be more actively involved with it. But in any case, I think a lot of people will start here, just maybe if they have a job with a 401k or something like that, just kind of investing very passively, but then starting to get more interested. You move up to this level, you start getting more interested. Maybe you start making some good decisions, a couple good investments. You start making enough money that it's worth investing more of your time. And then you get up to this level right here. So when it comes to finding your edge, my feeling is that with a $500 account and the tolerance to lose it in 1 year, you've got to be, in my opinion, not investing in S&P 500 index fund, but actively trading generally low price stocks or YOLO trading. Now, a YOLO trade sort of inherently indicates you don't know what you're doing, unfortunately. And so I'm not really an advocate of this, because I don't think that this is like buying a lottery ticket. And I think you're just going to spend $500 on a lottery ticket, and most likely you're going to lose, and you're going to wish you hadn't done it. So while this is something that you could do, it wouldn't probably make that much sense. So I think for most traders with small accounts, actively trading low price stocks would be sort of the most logical way to grow that $500. And if you said, oh, all I have the ability to do is index funds because of my time, then I'm going to tell you that you're probably only going to make $40 to $50 per year on that $500. In other words, you might be better off investing that $500 in yourself to increase your earning potential if you're trying to get a job, or you're trying to study something new, or you're trying to build your own business. I mean, I see so many people that get a pressure washer. Next thing you know, they're going house to house earning. I mean, they pay off the pressure washer in like a day. People do that with a lawnmower also. They buy a lawnmower. Next thing you know, they're mowing lawns and they're creating their own business. So that $500, you're trading essentially again for your time. You buy something that you can use to help make your time more valuable if you're doing side hustles. And trading is going to be that. You're going to use this basically as the vehicle to allow you to actively trade, but it's still going to take a time commitment. Now, the next level up, a $5,000 account, I still think active trading is the most logical thing if you're looking to grow that account quickly. However, at a $5,000 account, you could put it in a S&P 500 ETF and just let it ride and not think about it. It's going to grow slowly, but over the course of 5, 10, 15 years, it'll probably grow to $10, $15, $20,000. So, if you keep adding to it, it'll keep growing. But yeah, turning 5,000 into 20,000 over the course of 15 years, not the most exciting return, but at the end of the day, that is scalable. And you could do the same thing with a $5 million account. You put it away, you don't look at it, 20 years later, it's 15, 20 million. That's not unrealistic, putting it into index funds and bonds maybe, and then maybe delegating a smaller amount of that 5 million for active trading, like $25,000 worth. And this is something kind of interesting because for me, even though I've made a lot of money trading, I don't keep all that money in my trading account. I always take the money out and I put it into a long-term investment account that looks like this. I don't want to really lose more than 10% of that account. That's money I've made trading. So I put it in index funds and I put it in bonds, and it's invested very conservatively because all I want really is to see it just continuing to grow a little bit passively without taking a lot of risk that it's going to, that I'm going to lose 50% of it. So I would never put the $5 million in Nvidia. While it's true that if I had done that 2 years ago, I could have turned, the 5 million that I made in my Roth IRA in 2020 and 2021 into 10 or 15 million dollars, I would have literally had to be comfortable with potentially losing 50%. Was I ever comfortable taking $2.5 million of risk? And the answer is no. And so for that reason, whatever I could have made is totally irrelevant, because if I can't stand the downside risk, then you shouldn't have taken the position at all. People are so good at hindsight being 2020 that, I should have put everything. I should have mortgaged my house. I should have done a payday loan, and I should have put it all on, GameStop calls. Yeah, well, yeah, right. If you could see into the future, then of course you would, but nobody can. So you have to be thinking risk first. When you start getting those, kind of visions of grandeur of, I could quadruple my account in 4 hours this way with buying some expiration that expires today at 10 cents and it goes to 40 cents. It's just, that's gambling. That's a gambling mentality. So you don't want to do that. Now I want to share with you here some of the mistakes that I made. So as I was trying to figure out how to approach the market, my mistake that I made in 1998 was during that period of time, and I've told this story before. Some of you have heard it perhaps, but I was in school, and the school that I went to was a Montessori school, and we had a semester that was basically a mock stock market where we were stock brokers. And we were buying and selling stock, and we were trying to measure our performance. Now, I later found out that this was just a carefully disguised way of teaching us how to do basic math and get good at math. But for me, it really stuck. And it actually included a trip down to New York City, from Vermont to New York City, so we could go see Wall Street. Now, as it turned out, the day we went, it was like a crazy snowstorm, and we didn't actually get to go onto the floor. We were supposed to, and it didn't happen. It was a shame. Anyways, doesn't matter. At the end of the day, it was a meaningful semester for me. And so at the end of that semester, I decided that I wanted to put all of my money into one stock, and it was a penny stock. The company was the American Ski Company. They owned at the time a number of ski areas in Vermont and probably other places around the country. I called my local stockbroker's office because in 1998, I was a teenager. Well, actually, I was 13 years old, so I was a teenager, and I was very interested. I wanted to make this happen, but I didn't have my own investment account. So I called Edward Jones, which was on just on Western Avenue in Brattleboro, Vermont. They had a small little office, and I said I'd like to buy $100 of American Ski Company. This is my life savings. Now, my first job was a paper boy, and I earned $5 a week as a paper boy. So, and this was just in the 90s. This wasn't even like in the 1950s. $5 a week. So it took a while to raise $100, but nonetheless, I had $100, and they said, "Well, son, there's going to be a problem. It costs $50 to buy and $50 to sell. That's our commission. Come back when you've got some more money." And so I was sort of defeated. I was like, "Oh man!" But you know what? If I had bought that, you know what would have happened? And it's worth being aware of this because, you know, this is how you learn. So American Ski Company. Let's see. American Ski Company, founded in 1994, was one of the largest operators of alpine ski. Notice the key word was. So what happened to the American Ski Company? Early 2000s, the company sold all the assets and shut down. Okay. So they went to zero. The stock is gone. All right. So that was a learning opportunity. Even though I didn't actually buy the shares, I kept following it to see what would have happened if I had. And I saw that it dropped. So in 2001, a few years later, while I was in high school, I now had $1,000. And I said, all right, now I'm going to open my own account. And my parents said that was fine. So I opened my own account with Ameritrade. I funded it with $1,000. And this time I took a different approach. This time I diversified. I invested the full $1,000 and I invested in a number of different stocks that I was familiar with. I bought Caterpillar, I bought Pfizer, I bought Cannondale Bicycle, which was a little speculative because I like bicycles, but nonetheless. I bought US Steel, I bought ExxonMobil, American Electric Power, and there were a few others. I can't remember them all right now. So I bought these stocks, and this was in June. So school was out for summer, and what I did was I sat down. I had kind of like my, I had a ledger. It was a yellow kind of legal pad like this. And I wrote down all my positions, the reason I was getting in, what my thesis was, you know, why I like this stock. And I proceeded to watch the market every single day. I would open my account. I would check it. I was so excited. It was so fun. I was like, I'm a stock investor. By the end of the summer, you want to know what happened? My account was more or less unchanged. The problem was I invested $1,000 into really like S&P 500 type of stocks. They didn't change in value. So, I mean, over the course of 3 months, they didn't really change in value. A couple went up, a couple went down, and I lost a little bit because of fees and commissions. I think it was maybe $67 or $73, something like that. It wasn't a lot, but it was, you know, you had to pay a fee every time you bought and sold. And so anyways, so at the end of the summer, I was kind of defeated. I sort of felt like, oh man, that didn't really work so well. You know, I had this idea and, I guess you need more money than I had. And that's true, that for that strategy of dividend investing or being diversified across 10 different large cap stocks, $1,000 isn't enough. Those stocks probably, I mean, if you track them now, we can look at those stocks. I had the right idea. If I had kept that $1,000 in all of those stocks, it would be interesting to see how they performed. But, you know, ExxonMobil from 2001 through today, there's no question about the fact that, actually, I'm gonna have to change my settings to load more. But there's no question that these companies pretty much across the board are up over this, you know, 24-year period, except maybe Cannondale Bicycle. We could see what that one is. Cannondale Bicycle Company. So Cannondale Bicycle stock price. So it looks like they must have gotten bought out at some point because they're not still, it doesn't look like they're still publicly traded. It's been defunct since 2013. So that's not a surprise. That was a little bit more of a speculative one, but nonetheless, the others are all doing, you know, quite well. But with $1,000, I had kind of the idea that I was going to make more money that summer than I would have made with a regular job. I was treating it like a job, but I wasn't making money like it was a job because I was buying things that weren't moving. Okay. So then, as many of you guys know, so that was in 2001. So these were my first two attempts, 1998 and 2001. Then I graduate high school. I go off to college. And in the middle of college, my father is diagnosed with stage 4 lung cancer. I move home. I drop out of college, move home. And I'm staying at home, driving him to chemo and radiation. And I did some classes at the Community College of Vermont during that time. And I was working at a gas station. So I'm working at a gas station pumping gas, and I don't have any money. I've got nothing. My parents are helping me out. I'm living at home. I'm helping them out too, I guess. And I had no money. So stock market was the last thing on my mind. I was playing video games, Grand Theft Auto, whatever, PlayStation, and just hanging out with local friends and, not thinking about the market at all. My father passes away, and then I kind of had this period where I was like, all right, what do I do now? I ended up enrolling back in college. I finished my 4-year degree, and I graduate right into the Great Recession. So when I graduated, the market was at its lows. The economy was at its lows, and employers were not hiring. I ended up getting an unpaid internship. I tried to apply to work at a hedge fund in New York City because at that time I was like, maybe I'm going to give this another try. And the hedge fund said no. They were having people with their like MBAs applying for unpaid internships. So I didn't have that. I don't even think I had graduated when I applied for the internship. So I ended up getting an unpaid internship, and I worked there for a while, and then they made me an employee, and I worked there for a while. This is at an architecture and design studio, and it was in New York. And I kind of enjoyed that for a while, but the market was really in a difficult position, and it was hard to get work. And I ended up moving back up to Vermont. The job that I was at, business was slowing down, so I could see the writing on the wall. So I moved back up to Vermont, and I decided, and now I've got some money from my father from when he passed away. So now I've got this money. I had watched it decrease in value, and I thought naively maybe I could manage it better than the investment advisor that was managing it before. And so I took some money out, and I started trading with it. And I approached it differently this time. When I was in high school, I had a friend who had made $16,000 trading a penny stock. He bought a penny stock and he sold it for $16,000 of profit. And so that was like in my head that was like potential. So now I'm like, I've got a little bit of money. So what did I start doing? I started looking for penny stocks. That was like my first thing. So I'm not looking at ExxonMobil. I'm not looking at Apple or, US Steel or any of those big companies. I'm looking for penny stocks. But what ended up happening? Right away, I get caught up in being in the dump of these penny stocks that are dropping, and I lost some money. And so I'm like, okay, this is harder than I thought it would be, but I started seeing I guess it was probably Twitter at that time. I started seeing there were people out there who were making money. So I was like, okay, there is something in here. I just have to figure out sort of a system. How am I going to choose which stocks to buy and which stocks I'm not going to buy? Now, I was in a position here where I had a couple things going for me. Number one, I had time. I had the time because I was in Vermont and I didn't have another job. So I had a lot of time that I could dedicate, and I was happy to trade my time for potentially making money in the market. And number two, I had a little bit of money from my father. So that gave me a little bit of a cushion in two ways. Number one, it covered my cost of living in Vermont, which was pretty minimal at the time because I was single. Well, I was single and then I got married, but still our cost of living was very low. We didn't have kids or anything like that. So, I was in a position where I felt like I could essentially use that money to buy me some time, learning how to trade, covering my cost of living. So I spent the next 2 years going through trial and error. And step one for the strategy that I now trade today, what I discovered through that 2-year period of trial and error was that consistently my biggest winners had a set of common denominators. And this was kind of important. So if you look at my metrics right here for the last 90 days, you can see the last 90 days, I'm at $513,000 in profit in the last 90 days, just right there. What you would see if we look in detail is that the stocks I'm trading are all very similar. they have similar characteristics. And I'm going to share those with you to help you understand what my edge is. And this is an edge that I think exists not just for me, but for really all retail traders, because this is a niche. This is a little corner of the market where, big Wall Street institutional banks aren't really trying to dominate because there's not enough money for it to be really worthwhile for them. There are some smaller private investment banks that do engage in IPOs and secondary offerings and stuff like that for these lower price companies, and there can be some challenges there. But for the most part, this has been a pocket that's been pretty safe for me now for more than almost 15 years, so more than a decade. So what I ended up realizing during my sort of 2-year learning curve, my trial and error period, was that for me, penny stocks were really difficult. Penny stocks literally being stocks at 15, 20 cents a share. They were really difficult because a lot of them are OTC stocks, and they're companies that there's like no regulatory filings on them. There's no financial filings. They're kind of like shell companies, a lot of them that are just used essentially in pump and dumps. They get pumped up, insiders sell shares, and they drop back down. And usually retail traders get caught holding the bag. And that's what happened to me. So I was like, okay, that's not going to work. And then I tried trading stocks like Apple and the S&P 500, but I tried trading options because the options are volatile enough intraday that you can make 10% in one day, which is kind of like, if you can grow your account 10% in one day, you only need to do that a few times a year to have a great year. So that's kind of what I got focused on. But I realized when you're trying to trade Apple or the S&P 500, you are trading against the Wall Street bankers. You're trading against the high frequency trading algorithms that they've developed to take money right out of our pockets. They are so good. It's like playing chess against the computer, and it's almost impossible to win. So I realized I don't have an edge. So I spent these sort of 2 years trading a little bit of everything. I traded options, small caps, large caps, mid caps, and I didn't find consistency. I was struggling. And then I had a turning point. And my turning point was actually a big red day. I had a huge red day, but what it did was it actually made it so I couldn't trade until I added more money to my account. But it forced me to step back and look at my metrics. And because I have been so diligent about tracking all of my trades in, sort of a journal, I was able to look at my metrics and I was able to do some digging. So I'm gonna do a little example for you. I'm gonna go back here to the month of March. March was a tough month for me, and there were some lessons from March that I applied to April. So during March, you could see a couple big red days. There were 4 red days, and didn't really have a ton of profit. So I was up $20,000, which for me is not a lot of profit for 1 month. Okay, so if you look at all of these metrics, probably for most beginner traders, it's kind of hard to see what's going on. But what we have here, we've got my average winners, which were $742, and my average losers were $1,100. So what we know right now is that my average losers were bigger than my average winners, and that's not great. But my accuracy was 64%, and that's why I was still able to be profitable even with that negative profit to loss ratio. But we look at days and times, and we notice that I was red on Mondays and Tuesdays, which is kind of interesting pattern. And I was green on Wednesday, Thursday, Friday. That's probably something noteworthy to pay attention to in the coming months. And we noticed that I was red on trades that I took early between 6 a.m. and 7 a.m. And I was red on trades that I took later in the day. So I took this information, and the first thing I said was very clearly every day of the week, I should tighten in my focus to this area right here. From 7 a.m. to 12 p.m. cutoff. And so for the month of April, I said, based on this data here, I'm going to make a change. And that's what basically I had 2 years of data. So I was able to sort all of that data and come to similar conclusions. I was like, all right, I've got 2 years of trading. I don't have anything to show for it, but I've got a lot of data. What is the data telling me? And the data showed me that I actually would be a profitable trader if I stopped doing this, I stopped doing this, and then I switch over to price and volume. If I stop trading stocks over $10 a share, I stop trading stocks under $2 a share, and all of a sudden, all I'm focusing on is the areas in green. And because now I'm getting kind of a clue at what I can focus on, I'm getting a sense of confidence. I'm like, okay, wow. And here's the thing. This is all the trades I took during that period of time. I was trading a lot, these higher price stocks, but I had nothing to show for it. So when I cut all of this out, it allowed me to spend more time focusing on these types of stocks. So this was the month of March. I was up $20,000. I was feeling not great, but I came away with some actionable steps I could use for April. So now we look at April, $45,000. That's much better. We look at the profitability. I hardly traded anything under 2. I didn't trade hardly anything over 10 and nothing over 20. So this is where I got really focused in. I did really, really well here. And then we look at days and times. I didn't trade. Well, actually, it looks like I lost a little bit here. But this was within the parameter that I had set for myself between 7 a.m. and 12 p.m. So I stayed focused pretty much within that parameter, but I made the most money in the first 2 hours. And the result was clear. So this highlights the importance of data for helping create your strategy, for helping you find your edge, right? It's possible that you've already been trading long enough that you've got a lot of data, and we could import that data and we could analyze it just like I did right here. And we could discover, wait a second, you actually might be a profitable trader right now, if only you stop doing this, 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 and this. Now, that may not be the case. It may be the case that you're a brand new trader and you don't have that data at all. Or it may be the case that you've been doing a lot of different things and you really don't have a strategy or anything in there that's like a systemized approach of how you trade, where you get in, where you get out. In which case, all right, it's time to adopt a strategy that is currently being traded by other people. So here's what I'm gonna do. I'm gonna put a link. It's gonna be pinned at the top of the comments and linked in the description where you can download my trading plan. It is a set of rules, a system, a strategy that you can follow. Now, I always want to encourage you to trade it in a simulator and prove that you can follow the strategy that's profitable for me with profitability for yourself in a simulator before putting real money on the line. Just because it works for me isn't a guarantee it'll work for you, and I'll tell you why. I have the discipline to follow the rules of my strategy. I'm going to give you the strategy, but if you don't follow the rules to the T, then your results will certainly vary. And realistically, results will always vary. And I always say that my results in trading are not typical because I have a lot of experience. I have a lot of educated intuition, and all of that manifests to where I'm at today. But as a beginner, what you want to do is you want to prove in a simulator that you can generate some consistency before putting real money on the line. So right here, I end up spending 2 years sort of going through trial and error. And this is what I ended up discovering. And I'm going to kind of narrow this down into 3 simple steps. The first step for me is that I've learned that I consistently make the most money, and we can delete this time period. And we're going to go, this is $13 million of gross profit. And so what I know is that I consistently make the most money trading in the morning. That's the truth. So now when we start to think about the strategy that I'm trading, this is sort of telling you exactly what time I'm trading, right? So I'm doing the best in the morning. And then I learned I do the best on certain price stocks. I do the best on stocks that are up a certain amount on the day. They have to be up a certain amount in order for them to be worth trading. So now that I understand the type of stocks I make the most money on, what I set out to do each morning is to find the stocks that share the common denominators of having the potential to become my big winner for the day. So I can already tell early in the morning if a stock has essentially meets the criteria, meets the profile. And if it does, then I'm going to trade it. And if it doesn't, then I'm not going to touch it at all. And this is all as per the trading plan that you guys can download. So step 1 is to find the stocks that are moving. And of course, I'm using stock scanners to find these. Now, this platform that you see in the background on that slide, you see right here, this is called Day Trade Dash. This is software that I've been developing with a development team that I hired in 2017. So we've been building this out for the last 7 years, and we continue each month, each week really, to add new features and to grow it. And my goal when I started building this was that I was leading this community at Warrior Trading, this community of active day traders. And as the community was growing and the business was growing, I wanted to create the ultimate dashboard that all active traders would use. That would just be like the no-brainer. It just has everything in one place. It's got the best scanners, it's got the best charts, it's got the news feed, it's got chat rooms, it's got broadcasting. It's just everything in one place. And so that's what I've been building out for all of these years. So I use the same software that my students use at Warrior Trading. So number 1, I'm looking at the scanners for the leading percentage gainers, because what I know is that when a stock is up 160% on news, while some would say it's going to be up way too much, I would say that's a great momentum opportunity. This is a stock experiencing a really strong trend, and if I can find a place to buy with minimal risk, this is going to be my highest likelihood of capturing a 10% intraday return. A stock that's up 160% can easily go to 175, 180, 200, 220, 250, 260, 280, 300. It's so much more likely, in fact, that a stock that's already up 100% goes up another 10% versus a stock that's not up at all going up 10%. So if a stock's not up at all, what would make it go up 10%? It needs to have news. But if a stock is already up 150%, it's already got news. It only needs to continue to be interesting, and then it's going to be up 160, 170, 200%. So this is my focus, to look at the number one leading percentage gainers each day. So step one is to find those stocks, and I do that using the scanners. Step two is to perform my due diligence, which is a combination of fundamental and technical analysis. I check the news headlines, I try to understand why the stock is moving up, and then I look at the charts and I try to evaluate these candlestick patterns and decide, is there a place here where I can buy with minimal risk? Now, when we look at Intel, we go back to this sort of case study of Intel, and one of the problems here with the Intel trade, INTC, you've got a stock where the candlestick chart was diverging from the opinion that this person had. Their opinion was, they had a thesis of all the reasons it's going to go back up, and the price is cheap right now. But the price was cheap for a reason. The market was pricing it at that low level. The market knew more in this case, and the market was right. So you never want to ignore the technicals. The technicals are going to tell you whether or not this is worth trading. So for instance, on just the last trade I took, I was up about $9,000 over the last 2 days trading this stock, WHLR, which ended up going from about 80 cents a share or about $1 a share, all the way up here, climbing up, pulling back, and then pushing all the way up to $15, which was really incredible. And this had a news catalyst. So this is the type of stock that, I'm not saying you should put $700,000 into a stock like this. This is a small cap stock, but at the end of the day, he would have been a lot better off if he'd been focusing on these types of stocks. He actually, what I think probably should have done is put all of that money into the S&P 500, because that's something that he could depend on being there in 10 years. The S&P 500 is going to rebalance. It's going to pull some stocks out, put some new stocks in, new companies in. But that would have been, and if you lose 30% on the S&P 500, you know that historically it's going to recover. When you lose 30% on a single stock, it might not recover. Let's look at DocuSign. Let's look at a stock that, hit an absolute incredible peak during the pandemic. Do you think it's ever going to go back to those levels? It's currently at $59 a share after hitting a high of 320. It's probably, it might never go back to that level unless we have another pandemic. But even then, it probably won't. Zoom, ZM, another stock, same thing. It's at $67 a share. Pre-pandemic, pandemic, post-pandemic. Right? So, this stock is not going to go back to those levels. So if you're a bag holder on it, it's like, well, and I don't know that that's going to happen with Intel. Intel, I don't know, but you got to trade the technicals that's right in front of you. That's the moral of the story. So I focus on trading those technicals. So my technical analysis is looking at the candlestick charts, checking the position of my indicators, and then looking for an entry where I think I can manage my risk. And step three is where I'm actually taking that trade. That's where I'm actually buying and selling. Now, I take the approach, and if we look at my metrics here, you could see my average hold time is pretty short. One of the reasons I have a short hold time is because inherently, I've always been kind of a nervous investor. I've been nervous and just like, I don't want to lose. And so what I found is that it's easier to predict what a stock is going to do in the next 5 minutes than in the next 5 hours, or the next 5 days, or the next 5 weeks, the next 5 months, or the next 5 years. The shorter the time frame, especially when you're dealing with a stock that has breaking news right now, the easier it is to predict what it's going to do. And the traders who can accurately predict what a stock is going to do will be the ones who make the most money. So naturally, these big Wall Street executives, they have an uncanny ability to predict what a stock is going to do months in the future. But it feels that a lot of them have an unfair advantage, an edge that you and I will never have. As retail traders, if we see a stock that has breaking news at 8 a.m., that they've got a $160 million infusion of capital from NVIDIA, or the NVIDIA is taking a stake in the company, all of a sudden, this small company now has a good chance of being the #1 leading percentage gainer in the market today for small cap stocks. And it could easily go up 50%, 75%, 100% or higher. So anytime that stock squeezes up and then pulls back, those pullbacks can be a buying opportunity to ride that wave of momentum the next leg up. And that's what I do every single day. I'm a volatility trader. I'm focusing on trading stocks that have breaking news. Because news comes out in the morning, I trade in the morning. So I discovered all of this through trial and error, but this has become my edge. And this is the edge that I share with retail traders, because this is an edge not just for me individually, but for retail traders at large. We look at retail traders who did really well during the pandemic, and they were trading this exact strategy that I trade every single day. They were trading momentum on stocks that had news. Now, of course, during the pandemic, we had some stocks that made absolutely incredible moves. I mean, they would go up 500 or 1,000% in one day, probably like the dot-com bubble, where you just had incredible volatility. And that was pretty amazing to be part of that. Right now, the volatility is a bit more subdued compared to that. But it doesn't change the fact that when we step back and look at where I'm at in the last 90 days, in the last 90 days, I've got $500,000 of profit. Now, I'll say my results aren't typical, but this is telling me that the market is heating up. And there's definitely opportunities to be had for retail traders who have a strategy, a system, and a set of rules that they're following. Developing your edge is what this is all about. Now, you may find that you learn the strategy that I trade, and you may find that, I don't have the time commitment to be able to trade every single day. So you're going to have to find a strategy that fits better within your risk profile or your time commitment or whatever the case may be. One of the real challenges in trading is learning new strategies, because there's only so many people out there like me who are sharing their strategy and are proven profitable. If you're ever curious, you can come over to warriortrade.com. You can check out my broker statements that are on the website. If I go down to the footer here, you'll see, earnings statements 2024 right there. So these are all my broker statements. You can see them down here. These are for each month. And then if we go back up, you can also check my audit. And this is all those broker statements being audited. This audit is updated at the end of each year. So this verifies my starting balance in January of 2017 of $583.15. Well, they rounded it, but anyways, $583. So that was a $335,000 year in 2017. So 17, 18, 19, 20, 21, 22, 23, etc. All right. So with that, I have the link in the description for you guys to do a 2-week trial for those of you guys who are interested in trading side by side with me for the next 2 weeks. And I have the link in the description for you guys to download my trading plan. So I hope you guys check them out. Thank you for tuning in for this episode. I hope you hit the thumbs up and are subscribed to the channel for more episodes about trading strategy just like this. And hey, I want to remind you, as always, that trading is risky. My results aren't typical. So manage your risk, take it slow. And I'll see you guys back here for the next upload real soon.